All right, Chapter 8, Reporting and Analyzing Long-Term Assets. So we'll start with the cost principle and estimating or computing the cost of plant assets. We're going to talk about depreciation in more detail, which is something we've already looked at a little bit in the previous chapters. And then we'll look at asset turnover towards the end of this lecture, as well as accounting for natural resource assets and intangible assets as well. All right, so cost principle and computing the cost of plant asset. So plant assets are tangible in nature. They're actively used in operations. They're expected to benefit future periods, and they're generally called as a group property, plant, and equipment. So 4 issues related to plant assets. So we have to first compute acquisition costs. We have to allocate the costs to the periods that we think are going to be benefited. We have to account for subsequent expenditures, and we have to record for the disposal of those assets. So determining the cost. So basically, when you buy a plant asset, it's all expenditures that are needed to prepare the asset for its intended use. Those all go into the acquisition costs. Okay. So acquisition cost includes all normal and reasonable expenditures to get the asset in place and ready for its intended use. So machinery and equipment, what that looks like, for example, would be the purchase price plus the taxes, any transportation charges, any interest while it's in transit, and then any installation, assembly, and testing costs will also all become part of that cost of the piece of machinery or equipment. For buildings, it may include things like the cost of purchase or construction, maybe brokerage fees, taxes, attorney fees, title fees. All of those types of things become part of the cost of the building. And then land improvements. So land itself is not depreciated, but land improvements are. And those include things like parking lots, driveways, fences, walks, lighting systems, shrubs. And those are depreciated over the useful life of the improvements. And then land, although it's not depreciable, you still have a cost you have to record. And so that would include purchase price, real estate commissions, title fee, transfer fees, property taxes, survey fees, and title insurance premiums. Okay, so the total cost of a combined purchase of land and building is allocated based on their relative fair market values. So CarMax paid $90,000 cash to acquire a group of items consisting of land improvements, and building. So the way that the $90,000 cost should be allocated is based on their relative fair market value. So if we know that the appraised value is 60 for building and a total of 40 for land, that's 30,000 of the land itself and 10,000 of improvements. So we have a total appraised value of all the assets of 100,000. So if you take the percentage each asset is of the total appraised value, you get 60 and 40%. And if you multiply that 60% times the 90 lump sum purchase price, we should allocate 54,000 to building and 36 to land. Okay. So our entry for our lump sum purchase would be debit to building for 54, debit to lands for 36, and credit to cash for 90. Alright, so let's look at this need to know. So we're supposed to compute the amount of the new machine given the following payments related to its purchase. So we have gross purchase price of $70,000. We've got sales tax of $49, a purchase discount that was taken of $21, freight cost, terms FOB shipping point for $3,500, normal assembly cost of $3,000, cost of machinery platform of $2,500, and then parts used in maintaining the machine, $4,200. So the measurement principle, or the cost principle, requires that assets be valued at all necessary costs to get the asset ready for its intended purpose. So what would be our cost here? So we use our gross purchase price of $700 plus our sales tax, less our discount, plus our freight in, plus normal assembly costs, and plus the necessary machine platform. The only thing that's not included is the maintenance, that last one. So our cost of our new machine is $737. This right here, this cost of parts used in maintaining the machine, that's just a repair and maintenance expense, okay? All right, let's compute and record straight line depreciation, units of production, and declining balance depreciation. So we've talked about this briefly before, but depreciation is the process of allocating the cost of the plant asset to expense in the periods that are going to benefit from it, right? So when it's unused, we have our total acquisition cost on our balance sheet. And as it's being used, it gets put through expense by way of depreciation. So factors in computing depreciation, we've talked about this before, but cost, salvage value, and useful life are what you need. So what we're going to introduce in this chapter that I don't think we've talked about in previous chapters are some different methods of depreciation. So we've only talked about straight line to this point, but there's other methods that can be used, and that's what we're going to look at here. All right, so under straight line, this calc should look familiar. Cost less salvage value divided by useful life equals your yearly depreciation, right? And when we record that depreciation, we debit depreciation expense and we credit accumulated depreciation. And then the way that it looks on the balance sheet when we're using straight line method, right? Your asset value on your balance sheet is gradually declining. Your depreciation expense is even every period. And your balance sheet presentation is always less of your accumulated depreciation. If you look at it in a schedule form, your depreciation rate every period, in this case, is 20% because it's a 5-year life. And at the end of the period, we have our salvage value of $1,000, and you're recognizing an even number of depreciation expense every period. Under the units of production method, there's a two-step process. First, you have to figure out what your depreciation is per unit, and then you multiply it by the number of units produced. So the formula in step 1 is not really that much different than straight line. However, rather than dividing by the total cost or the total useful life, we're dividing by the total units of production. So cost less salvage value divided by units of production gives you depreciation per unit. Then you take your depreciation per unit times the number of units produced to get your depreciation expense. Okay? So let's try it. So assume 7,000 units were inspected in the first year. Our depreciation per unit is going to be our $9,000 depreciable cost, which is coming from here, divided by our total number of units, 36,000 shoes, 25 cents per unit. So then, if they assume that 7,000 units are going to be inspected during that first year, 25 cents per unit times 7,000, our depreciation in that year is going to be $1,750. So in a schedule format, your depreciation expense is going to vary based upon the number of units that you're going to sell each period. So in this case, in 18, they think they're going to sell 7,000, in 19, 8,000, 20, 9,000, and so on, right? So the depreciation cost per unit isn't going to change. It's always going to be 25 cents. But the number of units is changing, therefore your depreciation expense is changing each period. Okay? All right, and then under double declining balance, there's 3 steps. First, you have to figure out what the straight line rate of depreciation is. So 100% is the total that you're getting to, right? So you just take 100% divided by the useful life. So ultimately, you're depreciating 100% of the net asset, the cost less the salvage value. That 100%, or in this case, $9,000, is depreciated over 5 years. So 100% divided by 5 is 20% each year. Then you double it. So the double declining balance rate is going to be 40%. And so then your depreciation expense is going to be the double declining balance rate times your beginning book value period, your beginning of the period book value. So what this looks like in a schedule, so your very first year, You start with $10,000. That's your beginning of the period book value. Times 40% is your 4,000 expense. Then you have a net book value of 6,000, 10,000 less your 4,000 of depreciation expense. So you have a net book value of 6, which gets carried here. 6 times 40% is 2,400. Then 6,000 less 2,400 is 3,600. That's your beginning of the book period, beginning book value for the period. Times 40%, you're going to depreciate 1,440. 3,600 minus 1,440 is 2,160. That's your beginning. Your beginning times your 40% is 864. 2,160 minus 864 is a net book value of 1,296. And then in your last year, 1,296 times 40% is greater than this 296, but you can only depreciate up to $9,000 because that's your cost less your salvage. So what happens is this number in the last year usually ends up being a plug. The sum of all your depreciation expense less, or your total depreciable cost less the sum of all of your previous period's depreciation expense. Whatever that answer is, that's the plug that gets put into the last year. Okay, because you can't depreciate beyond your cost less your salvage value. Okay. All right, so comparing depreciation methods. So, I mean, straight line depreciation is most widely used among all companies. There are companies that will use those other methods. So it's important that we understand how to calculate them. Okay. All right, depreciation for tax reporting. So most corporations will use what we call the MACRS depreciation method for tax purposes. Stands for Modified Accelerated Cost Recovery System. And so what MACRS does is it provides for rapid write-off of the asset's cost in order to stimulate new investment. All right, depreciation for partial years and changes in estimates. All right, so when a plant is purchased or sold during the year, depreciation is calculated for the fraction of the year that the asset's owned. So let's say that we purchased a piece of machinery in October, and we're going to compute the depreciation expense for 17. We can't use the whole year's worth of depreciation because we only had it for 3 months, right? Roughly 3 months. They're rounding to the nearest month. So in this case, our depreciation for partial year would be our $9,000 cost less salvage divided by 5 years, but multiplied by 3/12 because we only are depreciating for a partial year. Okay. All right, so changes in estimates. So occasionally, actually probably more than occasionally, new information will come to light that may indicate that our original estimate of an asset's life was wrong and we need to update it. Because really we're predicting a useful life and we're predicting a salvage value to come up with a depreciation estimate, okay? So when we have changes in estimate for depreciation, let's look at how we handle those. So if our machinery from the previous example assumed, if we assume at the beginning of the asset's third year, when its book value is $6,400, 10,000 costs less 3,600 in accumulated depreciation. At that time, it's determined the machinery will have a remaining useful life of 4 years. An estimated salvage value will be revised downward from 1,000 to 400. What we do is we take our book value, which is $6,400 at this time, minus the revised salvage value, divided by the revised remaining useful life from that point forward. So our depreciation for the next 4 years will be $1,500. Okay. All right, so asset impairment. So permanent declines in fair value of an asset require that we write them down to their fair value. And so the way that we do that is we record the additional accumulated depreciation so that our net book value is reflected as the fair value of the asset. And then our offsetting debit is to an account we call impairment loss. Okay. All right, so let's look at an example. So a machine costing $22,000 with a 5-year life, an estimated salvage of 2,000 is installed on January 1st. Factory manager estimates that it's going to produce 1,000 units during its useful life, and then they give you what it actually produces. So the total number of units produced by the end of year 5 exceeds the original estimate, and it wasn't predicted. So prepare a table with the 4 column headings: year, straight line, units of production, double declining balance, and then compute depreciation for each year. So under straight line, we're going to take our $22,000 divided by less our 2,000 salvage divided by 5 years. So we have 20,000 worth of cost to depreciate every year under every method. Or let me back up. 20,000 of cost to depreciate over the life under every method. Okay. Line method. We've got our cost less our salvage divided by 5 years. So 22 minus 2 divided by 5. 4,000 per year, right? So under straight line, you got $4,000 each year. Under units of production, they produce each year. So we have 22,000 minus 2 divided by 1,000 units, so $20 per unit for the first 1,000 units produced. Okay, so they tell us that they think that the estimate is that we'll produce 200 in year 1, 400 in year 2, 300 in year 3, 80 in year 4, and 30 in year 5. Oh, I'm sorry. 1,000 units, and what they're depreciating is only 20 in year 5 because otherwise we exceed the 20,000. So although they're producing, the actual units they're producing is different, we're still depreciating or recording depreciation based on the estimates. So if we look at this column here, our depreciable units times our $20 per unit will give us our depreciation expense each year. Okay, so see, we can't depreciate our actual units because we would depreciate below our salvage value. Okay, and we can't do that. So the last year just ends up being a plug to get to the total number of units that were estimated. Okay. Then under double declining balance method, our rate is 20% under straight line, so it's 100% divided by 5 years. So if we double it, 40%, right? And then we take our double declining rate times our beginning period book value. So under double declining balance, our beginning period book value to start is $22,000 times 40%. Gives us a net book value of $13,200 times 40%. Gives us a depreciation expense of $5,280. 13,002 minus 5,280 gives us a net book value of $7,920. 7,920 times 40% is $3,168. 7,920 minus 3,168 is a net book value of $4,752 times 40% is $1,901 of depreciation expense. 4,752 minus 1,901 equals a book value of $2,851 times 40% is going to be greater than that $851, but that's all we need to get to a total of $20,000 in depreciation expense. Okay. All right. So early in January of 2001, the company acquires equipment for $3,800. They estimate this equipment to have a useful life of 3 years and a salvage value of $200. So our original depreciation would be $1,200 per year. 3,800 minus 2 divided by 3. Then early in 2003, they change it to a total of 4 years and a 0 salvage value. So our net book value at the time that they re-estimate would have been $3,800 originally minus the $1,200 for year 1 minus $1,200 for year 2. So we have a net book value of $1,400, and they're revising the salvage value to be 0. So, and they're saying it's a total of 4 years. So we have 2 down here. So we have 2 more remaining. So 1,400 divided by 2, we're going to take depreciation expense of $700 for each of the next 2 years. Okay. And there's the chart. So You're taking $1,200 in the first 2 years, and then you're taking $700 in the last 2, for a total of $3,800. Okay. All right, distinguishing between revenue and capital expenditures and how to account for them. All right, so revenue expenditures don't materially increase the plant's asset life or capabilities. They're recorded as expense in the current period, and they're reported on the income statement, whereas capital expenditures provide benefits for longer than the current period, and they're recorded as an addition to the asset account and reported on the balance sheet. So, this might be a good chart to bookmark. So, type of expenditure, ordinary repair. It's going to be a revenue expense. So, in other words, it maintains the normal operating condition of the equipment, doesn't increase productivity, and doesn't extend the life beyond the original estimate. When they call them capital or revenue, what they mean is it just gets expensed through a normal R&M expense account on your income statement, rather than getting capitalized to the balance sheet. Okay. And then if it's a betterment and/or an extraordinary repair, like a major overhaul or partial replacement, and it extends the life beyond the original estimate, that's when it's considered a capital expense and it's depreciated. Okay? All right, so let's talk about disposal. So disposal of plant assets. So you have to update your depreciation to the date of disposal, and then you journalize the disposal by recording either a gain or loss, removing the costs from your balance sheet, removing the accumulation from your balance sheet, the accumulated depreciation from your balance sheet, and recording the cash or whatever it was that you received in exchange for the disposal. So if your cash is greater than your book value, you have a gain. If your cash is less than your book value, you have a loss. And if it's equal, you don't have a gain or a loss. Okay? All right, so machinery costing $9,000 with accumulated depreciation of $9,000 was discarded on June 5th of the current year. Companies depreciating the equipment using straight line method over 8 years with a 0 salvage value. So in this case, the depreciation, the equipment is fully depreciated, and so we just have to remove it from our books. And the way that you do that is you reduce your accumulated depreciation with a debit, and you reduce your cost with a credit. It's fully depreciated, easy peasy. Okay. If it's not fully depreciated, let's look at what happens. So equipment costing $8,000 with accumulated depreciation of 6 on 12/31 of the previous year was discarded on 7/1 of the next year. Company was using straight line depreciation over 8 years with a 0 salvage value. So if it's straight line depreciation over 8 years, $8,000 would be $1,000 per year. So they had their accumulated account updated through 12/31, but before you dispose it, you have to update your depreciation and your accumulated through the date of the sale or the disposal. And so in this case, we need to record 6 months worth of depreciation. So we would take our $1,000 times 6/12, and we would update our depreciation expense with a debit of $500. And we would update our accumulated depreciation with a credit of $500 to increase it for depreciation through 7/1. Then when we sell it, we're going to remove our accumulated depreciation from our books. So we do that with a debit. So you have your $6,000 that they told you the balance was at 12/31 plus the $500 you recorded. You need to remove the equipment from your books. So we do that with a credit. And the difference to make your debits equal your credits or your plug is $1,500. And that's a loss on the disposal. Okay? So let's say we sell a plant asset at our book value. So on 3/31, BTO sells equipment that originally cost $16,000, has accumulated of $12,000 at 12/31 of the prior year. They use straight line depreciation at $4,000 per year. The equipment is sold for $3,000 cash. So on 3/31 they sell it. It had accumulated updated through 12/31 of the prior year, which was $12,000. Depreciation's $4,000 per year, so we have to record another what would that be? 3/12 of our annual depreciation expense before we dispose of it. So that's 3/12 of 4,000 is 1,000, right? So we're going to increase our depreciation expense to update our depreciation through March 31st with a debit of 1,000 We're going to increase our accumulated depreciation with a credit of 1,000. Then we need to record our sale. So they told us we got 3,000 cash, so we're going to debit cash for 3,000. Our accumulated depreciation was 12,000 at 12/31. We added another 1,000 to it in our journal entry in the middle of the screen here. And so now we have a total accumulated depreciation of 13,000. To remove that from our books, we debit. It's a contra asset, so it works the opposite of assets. We debit to decrease. And then we credit our equipment account, which is $16,000. So we credit our equipment account for $16,000 to remove the equipment from our books. We don't have any gain or loss in this case, okay? All right, so let's say we sell it above book value. So same scenario as the previous problem, except for this time we sell it for $7,000 cash, okay? So we're going to record $7,000 cash, debit to cash. Our accumulated depreciation is $13,000, so we need to remove that from our books, and we do that with a debit. Our cost of our equipment is $16,000, so we need to remove the equipment from our books with a credit of $16,000. And so we have $20,000 in debits. We currently have $16,000 in credits with the removal of the equipment. So we need $4,000 as a plug, right, to our gain on sale of equipment so that our debits equal our credits. Okay? All right, so let's say we sell it for below book value, right? So this is the same scenario as the previous two slides in terms of the cost and the accumulated. The only difference is the amount that we're selling it for. So this time we sold it for $2,500 cash. So we're going to debit cash for $2,500. We need to write off our accumulated and our cost. Take those to zero. So we're going to debit accumulated depreciation for $13,000. Credit equipment for $16,000. To make our debits equal our credits, we just need a debit of $500 to our loss on disposal. Okay? All right, let's go through an example. So the company pays $1,000 for equipment, expected to last 4 years and have a $200 salvage value. They want us to record the entries to the following costs related to the equipment. So in A, during the second year of the equipment's life, $400 cash is paid for a new compartment, expected to increase the equipment's productivity by 20% a year. So we talked about betterments and extraordinary repairs, right? So in the first one, when we purchased it, it's $1,000 to equipment debit and $1,000 credit to cash. Then the $400 that we put into it is going to increase our life. So we're going to book that to equipment, debit to equipment, credit to cash. In B, the third year, $2,500 cash is paid for normal repairs. That just goes to repairs expense. That does not increase the life and does not get recorded to equipment. Okay? And then during the fourth year, $500 is paid for repairs expected to increase the useful life from 4 to 5 years. And so in that case, that $500 will get recorded to equipment and the credit to cash. Okay? All right, so a company owns a machine that costs $500 and has accumulated depreciation of $400. Prepare the entry to record the disposal of the machine on January 2nd under each of the following independent situations. All right, so we got machine for $5, cash out the door for $5 when we bought it, right? Then we have accumulated depreciation of $400, they tell us, over the life. So we have depreciation expense of $400 and accumulated depreciation machine $400. All right, so that's to date. So our book value is $100. So knowing that, in letter B, when the company sells the machine for $80 cash, we're going to record the cash received as a debit. If our cash is less than our book value, we're going to record a loss. We're going to record the accumulated depreciation on the machine to date as a debit. We're going to record the machine cost as a credit, and then we're going to record the gain on sale of the machine if our cash is greater than our book value. All right, so in letter A, it says the machine needed extensive repairs, but it wasn't worth repairing, so the company disposed of the machine and received nothing in return. So in that case, we're going to remove our accumulated depreciation off our books. We're going to debit $400. We're we're going to remove our machine off of our books with a credit of 500, and we're going to record a loss on disposal. Okay. Then in letter B, the company sold the machine for $80 cash. So we're going to record our cash of $80. We're going to remove our accumulated depreciation, and we do that with a debit of 400, and we're going to remove our machine with a credit of 500. And we're going to record a loss on sale, right? Difference between our book value and the cash we got. Then in letter C, the company sold it for $100 cash. So that's easy peasy. We're going to record our debit to cash to increase it, and we're going to remove our machine from our books with a credit of 5, remove our accumulated from our books with a debit of 400, and our debits equal our credits. There's no gain or loss in that case because we sold it for the book value of it. Then in letter D, company sold the machine for $110 cash. So we're going to record cash of 110 with a debit. We're going to record our accumulated depreciation. We're going to remove it from our books, and we do that with a debit of 400. Remove the machine from our books with a credit of 500. Then we're going to record a gain on machine, or gain on sale of machine for 10. All right, so now let's talk about natural resource assets and how we deplete them. So natural resources, total cost is charged to depletion expense over the periods benefited. So it's very similar to depreciation. Same exact concept, different name, depletion. Okay. Extracted from the natural environment and reported at cost less accumulated depletion. So think about oil, coal mines, gold, that kind of thing. So let's say we have a mineral deposit with an estimated 250 tons of available ore, and we purchase it for 500,000, and we expect a zero salvage value. So we have 500 less zero salvage, 200 divided by 250,000 tons. We have a depletion per unit of $2 per ton. So very similar to units of production from depreciation, okay? $2 per ton times $85,000 extracted. It's 170,000 of depletion expense for that period, okay? So in order to record that transaction, we'd record depletion expense, mineral deposit, 170,000, and we'd record accumulated depletion for the mineral deposit with a credit of 170. Okay? All right. And then the way that we present it on the balance sheet is very similar to depreciation and fixed assets. We record our mineral deposit less our accumulated depletion for a net book value of 330,000. All right, so depletion expense when some of the ore remains unsold at the end of the year. So depletion expense, let's say that we have $30,000 that's still not been sold. We're going to record depletion expense only equal to the amount that's been sold, and the rest of it's going to be called ore inventory. $30,000, and you'd have accumulated depletion of 170. Okay. All right, so plant assets tied into extracting. So specialized plant assets are used to may be required to extract the natural resource, and those are recorded in a separate account and depreciated. So they're kind of like really no different than like equipment, basically. All right, so let's look at this example. So a company acquires a zinc mine at a cost of $750,000. It incurs $100,000 to access the mine, which is estimated to hold 200,000 tons of zinc. The estimated value of the land after the zinc is removed is $50,000. So let's record the entry. So we bought a zinc mine for $750,000 plus some additional cost to access it. So all of that becomes the cost of the mine. So zinc mine, debit of $850, credit cash $850. Then prepare the adjusting entries. If 50,000 tons of zinc are mined, but only 40,000 are sold. So we've got 850,000 divided by 50,000, which is the value after all the zinc is removed. So we have a total of 200 tons, or divided by 200,000 tons. It's going to be $4 per ton. So cost less salvage divided by the total tons equals the per ton rate. So the per ton rate times however many tons you've extracted and sold is going to be your depletion expense. So in this case, 40,000 tons are sold the first year. 50,000 are mined, so the other 10 is in zinc inventory. So there's your $40,000 debit to zinc inventory. and you're going to credit accumulated depreciation, or accumulated depletion, excuse me, for 200,000, which is your 50,000 tons times your $4 per ton. All right, so accounting for intangible assets. So intangible assets are things that you can't touch, right? So they often provide exclusive rights or privileges. They're usually acquired for operational use. There's no physical substance, and the useful life is, pretty difficult to determine most of the time. So here's some examples of things that are considered to be intangible assets. So patents, copyrights, franchises, licenses, trademarks, goodwill, leasehold improvements, research and development, and other intangibles. So a publisher purchases a copyright on a book for $1,000 on January 1st of the year. It protects the owner for 5 or more years. The company plans to market and sell prints of the original for 7 years. Prepare the entries to record the purchase of the copyright on January 1st. So when we buy the copyright, we're going to debit copyright, intangible asset. We're going to credit cash. Then they say that it's going to protect the owners for at least 5 years. So we're going to use that estimate to compute our accumulated amortization on copyrights. So on intangible assets, we amortize into expense the cost of the copyright over the estimated life or protection of that copyright. And so amortization, depletion, and depreciation are all the same idea, just different words, okay? So amortization expense works the same way as depreciation. It's just called amortization. So we take 1,000 divided by 5 years. We're going to record an amortization expense of $200 per year, and we're going to record accumulated depreciation of $200. Okay. All right. On January 3rd of this year, a retailer incurs $9,000 cost to modernize its store. Improvements include lighting, partitions, and a sound system. They're estimated to yield benefits for 5 years. The retailer leases its store and has a remaining 3 years on its lease. Prepare the entry to record it. So in this case, when we record our $9,000, we're going to call that a leasehold improvement. Debit leasehold improvement asset, and then we're going to credit cash for $9,000. And then when we depreciate leasehold improvements or amortize leasehold improvements, we're doing it over the lesser of the remaining lease term or the term it's expected to benefit. And so in this case, we're using 3 years because that's all that remains on their lease. And so we're going to record amortization expense, leasehold improvement. 9,000 divided by 3 years is $3,000 per year. And then we're going to record accumulated amortization for leasehold improvements of $3,000. Okay? All right, so in part 3, on January 6th, they pay $6,000 for a patent with a remaining 12-year legal life to produce a supplement expected to be marketable in 3 years. Record the acquisition and the amortization for the current year. So on January 6th, we record patents, $6,000. Patents is an asset account. We record our reduction in cash of $6,000. Then, although it has a 12-year legal life, it's expected to be marketable for 3 years, so we're going to use 3 years. So amortization expense is $2,000 per year, and accumulated amortization, $2,000 credit. Okay? All right, so total asset turnover, and how do we use that? So total asset turnover provides efficiency about a company's, or provides information about a company's efficiency in using its assets. And so it's calculated as net sales divided by average total assets. And so here we've got total asset turnover for Starbucks and for Jack in the Box. And so you can see Starbucks relatively flat asset turnover. So assets are turning over, I don't know, about 1.5 times on average. And whereas Jack in the Box assets are turning over about 1.2, 1.15, 1.07. So it looks over the history, Jack in the Box is actually increasing their asset turnover. So they're getting more efficient in using their assets. Okay. All right. So we're going to stop there. I'm not going to go through the appendix. I don't believe anything is going to be on the exam related to the information that's in Appendix A. So if you have any questions, as always, feel free to reach out. Otherwise, best of luck to you in getting through this chapter's material.